What if you knew exactly where the market is going to go after the market opens? So in this video, I'm going to share with you the strategy that actually got me more than $100,000 in payouts. So that by the end of this video, you will be able to go to the charts and do the same. So make sure to stick till the end of the video and let's get into it. So the first thing that we need to understand is that at 9:30 a.m. Eastern time, which is the market open, market actually does one thing, and that is it collects liquidity. So we will come to the exact part where I explain what it is, but right now we have two questions that we need to have answered, and that is what liquidity is market likely to run first, and then what liquidity is market likely to run second. And if we go with that logic, we understand that we only need to predict what liquidity is market going to run first, and then what liquidity is market going to run second, and that's it. And for this strategy, we are going to use the 9:30 open key level, so we know to either predict the move or to not even chase it because the move already happened. So it's going to be really important that we always mark out the 9:30 open level. So the first thing on the chart is we do mark a 9:30 open level, and that is going to be our key level for that session. So what it actually tells to us is we can measure what the premium of the market is that day and what the discount of the market is that day. And how do we actually do that is when we mark out the 9:30 key level, when the price is actually above that level, so above this key level, we are in a premium. Price is expensive, so everything up here is a premium. And when the price is below the open, so underneath this key level, so when price is somewhere right here, we are actually in a discount of the market. And if we want to buy into the market, it's really good because the market is discounted in the moment. So the whole logic is that in the premium we do not want to buy, and in the discount we do not want to sell. And the second thing we want to look at 9:30 is the highs and the lows below and above the price action. So when we mark out our opening key level, all we want to do is mark out some nice liquidities, which is just going to be highs above the price or lows below the price. So it's nothing complicated, just marking out the highs and the lows, because we know that above them and below them are buy stops and sell stops. And what that actually means for us is that they are really good liquidity points, because at them is a lot of orders in the market. So market is of course going to sweep them, because the point of the market for the market makers, bank and institutions, is to actually chase all the liquidity so they can actually extract the money from the markets, because all the liquidity it is just stop losses from the retail traders. So the first scenario we're gonna have that if the sell side is collected below the 9:30 open, so when we create our key level right here at the 9:30, all we want to see is a low getting swept by the price. And of course after that we are looking for a buy position towards the premium and towards some kind of high in the market, because that is the liquidity that market is likely to draw to next. And the second scenario for us is if the buy side is collected above the 9:30 open, we want to get a short setup. So after the 9:30, if we go into the premium to the upside, we sweep liquidity to the upside, so a buy side liquidity. All we want to see is a reversal to the downside. So we want to see the lows taken out, because we are currently in a premium of the zone and we want to trade towards the discount and towards the sell side liquidity or the lows in the market. And that is it. That is the whole strategy. So let me right now show you how that actually looks on the chart and how to execute it on the chart. Okay, so here we are at the actual market. So as you can see, if I put my mouse, you can see right now it is 9:29. So all we want to do is right before the market opens. So market open is of course about to happen at this exact spot. So all we want to do is mark out key liquidity level. So that level is going to be this price right here. So all we do is we mark it. And the next step is we want to mark out key liquidity levels. So if you look to the upside, we can clearly see that this one right here is the nicest and the cleanest high, so we want to mark it out. So this is our buy side liquidity. And then if you look to the downside, we have this liquidity right here, which is just the cleanest and the nicest one, so we can mark it out like this. And right now all we want to do is we want to either see the market going towards the downside, sweeping this low right here, and then after that giving us a potential upside towards the buy side liquidity. But if we go in the premium like this, we cannot get a setup to the upside because we are already inside of a premium. So we want to get a buy setup or a long setup inside of a discount when we actually sweep the sell side liquidity. So let's fast forward the market and see what actually happens. Okay, so we actually swept the buy side liquidity. So now what we want to do is we want to actually target towards the downside. But how do we actually enter the market? Because if we just enter randomly on a sweep, it is very likely going to lose. So all we do is we just enter based off of a fair value gap or an imbalance in the market, and all that is, it is just a 3 candle formation in the market that looks exactly like this. So this right here is a fair value gap. So you can see we have a first candlestick right here from its wick to the third candlestick's wick right here, and this is our imbalance and this is our fair value gap. And all we want to do, wait for one that happens right here to actually get disrespected. So let me show you the example. So if I fast forward the market, let's see if we even get the entry. So looks like we are going more to the upside, and you can see right now we have a fair value gap right here. So we have a body that is not covered by the wicks next to it. So we mark it out like this, and all we wait for is a disrespect of it, because if we disrespect this fair value gap, market is really likely to go to the downside, because the fair value gaps are actually a strong tool in the market to get respected and to kind of influence that we are going to retest them and continue the trend. So if they get disrespected, we are very likely to reverse. So let's fast forward the market and see what actually happens. So right now we are just going a bit to the upside, so you can also see why you can't just blindly enter to the downside without any kind of entry model. And let's see what happens. So there it actually is. So this is our entry model that we wanted to see. If I zoom out a bit, you can see that we are still in the premium of this range and we still have the untaken low down here. All we do is we enter the market like this. Of course, when this candle actually closes, we enter the market and we put our stop loss either on the body or on the wick. So we want to give it some space. We do not want to make it insanely tight like this, because market can maybe stop us out. So we will always want to give us some kind of space, and what we do is we of course target the low that we marked out previously, which is this one right here. And let's actually fast forward the market and see what actually happens. So you can see in the end we just beautifully went to that low, and potentially we can even target some of these lows down here if we wanted to. So let's see if maybe that plays out, and you can see that even that played out all the way to down here. So all this liquidity right here got taken out and we got huge profits in the market. So if we target this, we would have gotten 2.8 risk reward, which is of course insane. It's $2,800 on a simple $100,000 funded account. So let me show you one more example of this strategy. Okay, so here we are in the market. The same thing, if I put my mouse right here, you can see it is 9.29. So right now what we want to do is we want to mark out where the market is currently sitting at. So right now we know that right below this is our discount and we want to buy. Right up here is our premium and we want to sell. So if I zoom out the market, we can see this is right here an obvious high in the market. So we want to see it taken out. And this right here is the obvious low in the market and we want to see it taken out. If we right now, just as you know, skip the market or fast forward it, we are just waiting for which liquidity is actually going to get taken first. So we can see that actually the sell side this time got taken first. So you can see that we are in the discount of the range, sell side got taken. So all we want to see is an entry towards the upside. So all I do is I mark out the fair value gap, the last one that happened in the market. You can see that it's this one right here, and if I fast forward the market, all we are waiting for is a disrespect of that fair value gap. And there it is perfectly. So if I enter the market right now, stop loss somewhere below, because we want to give it some actual space. You don't need to put it all the way at the low because that is just huge. So let's say for example right here, and if I target this high to the upside, it's almost 2 risk to reward. And let's see how is this setup actually going to play out. So if I fast forward the market, you can see within just few minutes the take profit actually got hit, and of course we would have made a lot of money. And the point of this strategy, that is just so consistent, so it has actually really high win rate, which is just going to get us to be able to make these profits really easily. So just before you actually leave the video, if you like the video, make sure to like, to subscribe, and to of course comment something if you have any questions. And also I give out my free playbook of this strategy, so a 10-page playbook, so you can of course claim it down there in the description and you can use it when you actually trade this model. And one more thing that I want to mention is that at this model I actually run a one-on-one mentorship. So of course it is limited with spots because it's one-on-one. So if you are maybe interested in that, make sure to go down there in the description and of course check out if you are a right fit for it. So with all of that being said, I'm just gonna see you in the next video. Peace.